David Rosenberg returns to the show, president of Rosenberg Research. We'll be talking about his outlook for the economy. We'll break down what happened this week with the FOMC meeting. We'll talk about central bank policies from around the world, and we'll talk about his market outlook as well. David, good to see you. Welcome back. Great to have you before the new year.
Yeah, thanks very much. It's an honor to be back on the show.
Honor to have you as always, fan favorite. David, let's talk about what happened at the Federal Reserve. By the way, people can check out my last interview with David Rosenberg. Links down below so you can revisit his last views. But are you more or less bearish on the economy after what happened yesterday at the Fed? Basically, Powell, correct me if I'm wrong, but he didn't sound like he was going to back the economy to the same extent as he did before.
Well, I guess at the margin, the Fed pausing for an extended period is not something that's going to cause any economists to raise his or her growth forecast. My comment about Jay Powell and the Fed is that they're so focused on contemporaneous and lagging indicators, and so the whole notion of staying on hold because we had a couple of moderately higher core CPI and personal consumption expenditure deflator numbers. We had 2 months, God forbid. So it influences your whole view in 2025. I'm just spinning my head.
Yeah.
But I'm still, I think that what's happening with the economy, I can understand it. It's very confusing. Of course, the macro bulls take their cue from the stock market and they think that the economy is doing great. And they listen to Jay Powell, and Jay Powell says the economy is solid at the press conference and characterized the U.S. economy as strong and solid. And yet the Fed's own beige book that goes all the way back to 1970 and is I would consider to be the most comprehensive qualitative assessment of the U.S. economy, both across regions and across sectors. It described the U.S. economy just in the past few weeks as being slight. Economic activity is slight. We have slight growth, which true is not a contraction, but it's very close to stagnation. The beige book says slight. Powell says solid and strong. Well, which is it? Because there's more than a shade of gray between those two descriptions. And my comment to Jay Powell would be, if you're going to spend all the time, money, and resources on the beige book, as the Fed has been doing since 1970, why do it if you're not even going to listen to it? And I'd say that the broad survey data, look, we got, the Philly Fed index swung to pretty big negative. Most of the regional surveys, even on the services side, have been softening. Manufacturing is in a recession. And when we scorecard all the various surveys from in the private sector, it's consistent with an economy that's growing at a 1% annual rate, not 3. So there's a huge gulf here between what's happening in the real world and what's happening in the BLS. I just say take the L out of BLS, and that's what you got. The revisions are huge. The response rates to the first releases are at historic lows because of COVID and the slow small business response. I don't think you can put a lot of faith in the data coming out of the government. I'm not a conspiracy theorist. I'm just saying that there's a wider error term in the incoming data that everybody still trades off of, including non-farm payrolls. I think the economy, put it this way, I think it's less weak than is commonly perceived. And my sense is that what we haven't seen fully play out yet, David, are the policy lags. The policy lags, they are still kicking in. The damage the Fed did in 2022 and 2023 in terms of the economy resetting to a more elevated rate environment. Yeah, this reminds me of that cycle when I was at Merrill in the mid-2000s. The Fed first started hiking rates in the summer of 2004, went from 1% to 5.25% over a 2-year span. Much like they did this cycle. The Fed started tightening in June of '04.
Yeah.
And the recession nobody saw coming started in December of '07. And people got fed up waiting, and then they missed it. And it's much like this time around. The lags are long, and they're also variable. And the lags this cycle have been stretched for a whole host of reasons that I've written about. But I think that just as the Fed and the markets missed the inflation in 2021, 2022, I think that both are missing what's going to happen with the economy in 2025. I think things generally are going to be weaker than expected. Whether or not that means an NBR-defined recession, we'll wait and see once all the revisions are in. But I think that 2025, it's the Chinese year of the snake, and it's going to be a snake and a ladder. But I think for the economy, it's going to be a ladder we'll be climbing down from.
If you want to read more about the economy and the latest business news, Ground News has you covered. Today's sponsor, Ground News, is a fantastic news aggregator bringing together sources from across the internet into one easy-to-use place. Take a look at this article, for example. Federal shutdown fears as Trump-Musk torpedo funding deal. A lot of stories on the internet cover this particular story, so you can scroll down and you can see all the sources in one place without having to Google individual sources if you want to read from multiple news sources. Saves you a lot of time, saves me a lot of time. Bias distribution meter is cool. They have this meter that shows what percentage of the sources are left-leaning, center-leaning, and or right-leaning. Easy way to categorize different news articles on the political spectrum. The ownership meter is cool. It shows you what percentage of the stories are owned by independent media versus conglomerates, so you can make your own decisions on what to read based on that. Take a look at my link down below, groundnews.com/David Lin. We're scanning the QR code to get 50% off the Vantage plan under $5 a month for a subscription. Great deal, great resource. Check out Ground News. Even before the FOMC meeting happened, let's just back up a minute. The Dow has been on the losing streak, the longest losing streak since 1978, is what I've read. 10 days in a row before it finally broke this trading session today. David, what was the repricing, you think?
Yeah, I think it was actually the longest stretch since 74.
Hmm.
We'll have to check that. I think it's the thing about the Dow that's different from the S&P 500 and the Nasdaq is that it's very highly cyclical. The S&P has a lot of growth stocks. Nasdaq is all mega cap growth, but the cyclicality information is in the Dow and in the Dow transports, which have rolled over. And that's more or less, fitting into my view that things are cooling off. Again, it comes down to that question about the recession. The industrial sector has been in a recession for the better part of the past year. And the one thing we know is that the services sector that's hung in, well, the services sector services the production sector. And the production sector is in recession, but it leads by roughly 2 years. So I think the expiry date on this expansion, which has lasted longer than I thought it was going to, and I could say that for a whole bunch of people, the only difference is that I haven't thrown in the towel on the recession call. I've just been saying it's derailed, not delayed. The business cycle has not been repealed. But I think that, again, is the message from the Dow Industrials, as you just mentioned, and the Dow Transports combined.
This isn't just seasonal profit taking, David. This is a bigger picture here.
It's no, actually, if you seasonally adjust the data, seasonally adjust the economic data, historically, the market is up more than 1% in December. We're supposed to get the big Santa rally. December is almost always
Yeah.
an up month seasonally. The fact that it's down month to date with a few days to go, that's actually very surprising. So, no, I think it's just a reflection of concerns out there, concerns that maybe Donald Trump will be less pro-growth when all is said and done than what was initially envisaged, and the fact that the Fed is now moving to the sidelines, still leaving rates at elevated levels. People talk, well, they've cut rates 100 basis points, they've cut rates 100 basis points, but look how far inflation's come down.
Hmm.
Real rates, real rates, real rates are at 2.2%. Now, the stock market's behaving as if real rates are still negative. But we had 2.2% real rates, let me just say this, in the summer and fall of 2007, presaging a recession that everybody threw in the towel because they became impatient and tempestuous. And when you know that recession, as we all know in hindsight, started in December 2007. It didn't start December 2008. So when you're asking me what is the one variable, I know some people will look at the yield curve You talk about transports and industrials, but real rates, these real rates are at the higher end of the range of the past 20 years. And so I would say that that is going to be a tourniquet on economic activity, uh, at least for the next year.
Okay, this brings me to my next point about inflation. Take a look at the first question that was asked to Powell at the FOMC conference by the New York Times, and we'll evaluate what he said.
Gina Smilik with the New York Times. Thank you for taking our questions. Um, I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does it pause next month?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments.
I don't know if that's the statement he made that caused the markets to panic, but I'll let you evaluate what he said, and also the reporter's assumption that inflation will stay relatively intact throughout 2025.
It's such a simple question that can be answered in 15 seconds. It was just like, I don't
Yeah.
know about you, David. My head was spinning. There was so much bafflegab and nonsense. I know that all the cheerleaders were on Bubble Vision afterwards, talking about what a great press conference it was. I thought I gave it a D plus. Um, I mean, it's interesting that Powell has been saying that we're finally starting to see what the Fed was looking for, which was a break in the rental components, the rental service components, OER and rents, which are basically 40 to 45% of the core CPI. We finally are seeing a break in that series, which is going to continue into 2025. And you get the rental call right on inflation, you get the inflation rate right because it's the largest component. I wasn't impressed with that answer. I don't really know what it was he said. That is not what caused the market to accelerate to the downside. It's really when he talked about the fact that um, that policy is no longer significantly restrictive, and that the Fed is now all of a sudden not that far away from neutral. And I think that caught a lot of people off guard. That was the comment.
Well, were you personally?
That was the
Yeah.
uh-oh. He's really telling us with that comment. Forget about the inflation comment, okay? It's what he said about policy, that they are no longer viewed as being significantly restrictive, and that they're not that far off from neutral. So that's why, even though the market had already been pricing in only two rate cuts, and the Fed, of course, is projecting two rate cuts now. I mean, we have barely one rate cut now priced in, and that was what really got the ball rolling in terms of the fact that the market, which was going down after the press release, just cascaded into the close. That was really what the message was. That the hidden message was, David, everybody, we might not cut rates at all in 2025. That's what the interpretation was.
And that caught the markets off guard, of course, because that's not what people were pricing in. I see a lot of people in the comments of my own channel speculating whether or not this was just a political move. Trump is basically, he's waffling as to whether or not he likes power. But this is Powell's way of getting back at an administration he doesn't like. What's your take?
I don't think I buy that.
Okay.
I don't think it was political. Um, I think that they just have an opinion that's different than mine. Uh, I mean, I can't comment on something I don't know. If people are saying this was political, it's just, once again, it's an opinion. Um, there's no and nothing to back that up.
Sure.
Okay, but the reality is Powell's not wrong. We had a couple of above expected inflation prints in September and October. And that's what he's basing his decision on. And that's in terms of next year. And so is the entire Fed. I think there's a lot of FOMC members that are more hawkish than he is. I'm saying that this is not the first time the Fed has staked its claim on coincidental lagging indicators. The inflation rate, he talks about the 12-month trend in inflation. That is a lagging indicator. 12-month, the service sector CPI is in the index of lagging economic indicators. That's what he's focused on. So I'm really rather amazed at that, tell you the truth. But they've been focused on coincidental lagging indicators the whole cycle. That hasn't changed. That hasn't changed. So I wasn't I wasn't altogether that surprised based on the metrics that this Fed follows. This is not the Bernanke Fed, and it's not the Greenspan Fed. This is a different Fed that doesn't really have, provides an outlook, but changes it all the time and has no faith in it. They're focused on coincident to lagging indicators. That remains the game. And that was the same when Biden was in power. Like, with all deference, if he's so political, look what he did to the interest rates when Biden was in power in 2022 and 2023.
Right.
He raised rates. I mean, for views that somehow Powell is political Powell, he raised rates a lot more in the Biden regime than he did in Trump 1.0. So I would say, no, it's not political. I just think it's the same old Fed that they're going to whack around their dot plots. They're whacking around their forecasts like they barely touch GDP for next year. They barely touch the unemployment rate for next year. Oh, but core inflation goes from 2.2 to 2.5, which is actually a pretty big move for a glacially moving indicator. And I think that by the time we get to the March meeting with the new set of projections, we're going to go right back to 4. And we'll be in a different landscape. And of course, I think the incoming data will be different. And we're going to get the benchmark payroll revision. That's going to shock a lot of people that aren't paying attention to what's going on. But I think that that's what the Fed does. They whack around these dot plots and their forecasts like it's Bitcoin. So I don't know how much I would take it seriously. I was not at all shocked at the market surprise, just based on, his tone. His tone has really shifted, and he's become more hawkish, and not hawkish because of the politics. I think that he did mention that there were a few members. He didn't mention himself that that wanted to go slow on rates because of the uncertainty caused by the new administration. He didn't say that was his view. He said that was a few members, so not even a majority view. So, he threw that out there, but, who doesn't know that? That's not being political, really. That's just stating the reality. We are in a period right now of elevated policy uncertainty. I think that, I think what amazes me is not that, David. What amazes me is that, just like the beginning of the year, they were supposed to start cutting interest rates. Do you remember that? Do you remember they're supposed to be cutting rates? We had the big bond rally going into the end of last year. And then, oops, a couple of months of higher than expected inflation prints because of auto insurance and health insurance. It was an insurance story, and he backs off. And the 10-year note zooms all the way up to 470. And then what do you know? Oh, by September, they're cutting rates. The 10 years are 365, and they're dovish. And now they're hawkish, and this is a trader's dream. If you're trading this thing, it's a dream because he's just giving you that volatility. I think that I don't think we're in a new and higher inflation trend, not a bit. I think that the things that caused inflation to blip in September, October are going to fade significantly. Airfares, autos, hotel and accommodation. You're already starting to see some of the strains emerge in the leading indicator on consumer services on the cyclical side, which is restaurants. All this stuff is going to fade. And then what's going to compound the downward trend in inflation is going to be the rental components. We have a massive pipeline of rental construction coming into 2025 at a time when the vacancy rate nationwide is already at a cycle high. That is going to weigh on rents and is starting to finally feed through more dominantly in the CPI data. And
Yeah.
then in March, this Fed is not ashamed or abashed about changing its forecast very quickly. That much we know. And I think they'll be doing it again in March. So nothing in here I see is going to influence anything except the very near term.
So you don't think that this will be the last rate cut, bottom line?
Not a chance. Not a chance. Look, they still forecast two cuts. They see the bond market, the Fed was at four, the bond market was at four cuts. The Fed was at four cuts. Then quickly thereafter, because of the Fed's cadence, the bond market got ahead of the Fed and priced in two cuts. Now the Fed went to two cuts. They sounded hawkish again, so the market's saying, oops, I'm going to have to double down and maybe price in nothing for next year. And therein lies the opportunity. Because I think the economy is going to underperform expectations. I think the unemployment rate, if it weren't for the fact that the labor force participation rates declined the past couple of months, the unemployment rate would already be well above the Fed's forecast for the year. We'd be at 4.5%. So we're going to go above the Fed's forecast for unemployment. I think that the inflation was an aberration in September and October. I'm amazed that the Fed doesn't know that. But that's what they're telling us they're focused on. It is amazing that you can take a September, October data point moderately higher than expected and then tell the world, oh, we're going to add 30 basis points to core inflation forecast for next year. What does one have to do with the other? So I think that the downside risk on inflation is my call. The downside risk on growth is my call. The upside risk on unemployment is my call. And remember, the Fed does have the dual mandate. So I think that by the March meeting, we're probably back to four cuts being in the dot plots. And the Fed
Yeah.
will just say, look, he actually came out and said, we're focused on the current data. We're focused on, he came out and said, we're focused on the coincident indicators. They will be looking different come March. Come March, they'll be providing a new set of dot plots and economic projections, and I do think they're going to look a lot different than what they did yesterday.
Let's just take a look at what the market's pricing it. So yeah, 43% chance currently of one cut by March. No chance of any cuts by January. The bond market, 10-year spiking again today, the day after the FOMC. How much of this is just pricing in inflation? Would you take the opposite side of this bet, David?
It's not inflation. It's not
It's not?
inflation.
Okay.
I mean, you know what's really amazing is that, I watch these folks on business cable vision, okay? And they talk about coffee. They say, I saw this guy on CNBC a few times this week. I'm not
Okay.
going to say who.
Okay.
Saying, how can the Fed cut rates when you look at coffee and cocoa? Do you know that coffee and cocoa and sugar are the only commodities making a new high?
Yeah, I saw that.
Wheat? No, he didn't say wheat, which is well off the highs. Soybeans, well off the highs. Cotton, textiles, copper, the entire base metals, lumber, steel. So anything you can see, touch, or feel outside of cocoa, coffee, and sugar. What is the interest rate from the Fed that would cause cocoa to go down? Do you mind telling me? What does the Fed have to do with weather problems in Brazil and Colombia? Can you explain that to me? What about energy? What about is oil at $70? Oil and the whole energy complex well off their highs for the year. And that feeds into everything. And I got these nattering nabobs of negativity, and they call me a perma bear. Like, what? I can't believe that these people, and guess what? They're all overloaded with equities. And inflation is not good for financial assets, and they all have a big inflation call. But all I hear about is cocoa and coffee. They don't mention sugar. You should mention sugar too. So I guess we'll have to substitute. I guess we should start drinking tea or just hot water with lemon in the morning instead. But I mean, give me a break. The things you can see, touch, and feel are deflating. And now on the services side, the rents, that was the big story that got missed in November, was finally the break we saw in OER and the rental components.
Mm.
No more zero point 0.4, zero point 0.5, zero point 0.6s. We're now down to zero point 0.2 and probably on our way down to zero point 0.1. And people don't have a clue as to what the downward pull on inflation that's going to provide in 2025. So, look, I understand what's happening right now, and it's all related to the Fed. It's not inflation expectations. I know there's inflation expectations on by strategists and economists and analysts. I don't think the market's freaked out by inflation. Okay, I think that they're repricing the Fed. And the most important determinant of yields out the curve is not fiscal policy. It's not the dollar. It is expectations of the Fed. Where is the cost of carry going? Are you going to tell me that it was inflation? I mean, really, once again, at the beginning of the year, it wasn't about airfares and autos and hotel and accommodation and the like. And that was the last couple of months. I don't think that's going to persist, frankly. Beginning of
Yeah.
the year was about insurance. And you say to me, well, Rosenberg, look at the inflation numbers in like January and February. And I say, okay,
Mm.
I don't see a big problem there. The Fed got freaked out. And it's when the Fed said, no, we're not going to start cutting rates that soon, that you went up like over 100 basis points. We got to 470, the 10-year note, as the Fed got priced out. And then tell me it was like deflation or disinflation that brought us down to 365 in September. Was that about a shift in inflation, David? Or was it the fact that the Fed started to cut rates and signaled more, right? So now we're back. It's basically here. This is the game between Charlie Brown, Lucy, and the football. That's what it is. So, and if the market prices out the Fed, look, we have Torsten Slok at Apollo saying his view is there's a 40% chance the Fed's going to hike rates next year.
Right.
I mean, I put those odds as close to zero as anything could be zero. Nothing is ever zero, but that's what people think. It's all about Fed expectations. And if the market continues to price out
Well,
the Fed, then the 10-year note is going to go to 480 from where it is today. Now we're just basically that could be next week the way things are going. And I'll pound my fist on the table that that's going to be one great buying opportunity for
I,
2025. I'll tell
I,
you, no, because if we can recreate the conditions, which I
yeah.
think that is rational, that we get back to the mindset we had back in September when the 10-year note got to 365.
Yeah.
From where we are, say, if we get to 470, 480, we go back to those April highs of this year. That's over a 10% total return on the 10-year Treasury note. So I actually like this. You know what? I like the fact that yields are backing up because it's giving me a really great starting point to reload the gun on bond duration for 2025 at a time when nobody else wants to touch it.
I think what happened this week, I'm itching to get your market forecast. By the way, we've been talking for about 25 minutes. You have not used the word tariff once. I was listening very carefully. I was
Yeah.
like, when's he going to bring it up? He hasn't. So I'll
Mm.
bring it up later. Yields going up this week. It reminded people of 2022 when we had a terrible bond market. Yields went up. Stocks also went down. Right? Is that what's going to happen again in
No,
2025?
no, 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 no. In 2022, the Fed was tightening,
Okay.
and the bond market was playing catch up to the Fed tightening. The Fed's not tightening,
Fair enough.
okay? Despite what Torsten Slok says, Torsten Slok also said at the beginning of the year that the Fed wasn't going to cut rates this year. Well, last I saw, David, they've cut 100 basis points. Little different. The Fed was actually draining liquidity out of the market. They were raising rates and inverting the yield curve. And then you had a cyclical run up in bond yields and you had a cyclical bear market in equities. This is not the same thing. The equity market, of course, has got super duper inflated multiples. And we're in a period of more elevated political and, as you said, trade and tariff uncertainty, no doubt about that. And I would say that's really the big difference is what do you do? What is the rational thing for an investor to do in a period where uncertainty is high and rising? And the rational thing for an investor to do is to expect risk premia in the financial markets to go up. risk premia should be going up. None of this is very good news for financial assets, certainly not the stock market. And we don't know what Trump is going to do or not do. Uh, we know that this is a different, this is a very fiscally hawkish, conservative House of Representatives. I don't know how much Trump is going to get through the legislative process. A lot of people think he'll be able to get everything through. I'm not so sure with this group that he will, especially the 37 Freedom Caucus members.
Yeah.
But, he can still wave his magic wand and do things through executive order. And he has control over trade policy. He doesn't have to go to Congress. And that's the big unknown. That's the big unknown. Will he touch off a global trade war? And I think that certainly the stock market's got this view that we will get all the good stuff from Trump. We'll get deregulation, drill baby drill. We'll get all the tax cuts through, but none of the tariffs, or not the size and broad-based nature of them that's been advertised. But we'll see. That's the big unknown. That's what I talk about, the big unknown, the big uncertainty. Uncertainty means that you have to build in higher risk premia across risk assets. I don't think that, that has been done in terms of duration on the bond market. The stock market just finally recently figured that out. The reality is that, with, treasury bill yields at what, like 4.5%. You see, this is why it's not 2022 when cash was trash and getting you basically next to nothing. You get paid now to be in cash.
Yes.
And I think that we have to ponder, what does Warren Buffett, who is somewhere like around 35% cash position, which is unprecedented, what's Warren Buffett saying that everybody else isn't saying? So that, I think, is something that we should also consider.
Well, I want to get your outlook on the equities markets now.
Right. Sure.
You wrote in your note, this bull phase has now lasted long enough that those of us who have been on the wrong side of the trade need to take a different tack. This is not about throwing in the towel as much as trying to get a grip on what is going on beyond just calling this a bubble. Now, you mentioned this earlier in the interview. You're not throwing in the towel.
Okay, you can't. Okay, here's the thing.
Yeah.
I don't mean to interrupt or correct you. You can't just take that document and read 2 sentences out of it. You have to read the whole thing, and I don't expect you're going to take a half an hour and read the whole thing. I hope that the viewers will take the time to read Lament of a Bear, which I wrote last week, and then the sequel. But you can't take 2 or 3 sentences out of it. The point that I was making is that it was something that every analyst, economist, strategist, everybody should do this. And the end of the year is a good time to do it, which is some reflection and some introspection. And on the calls that you missed, come clean to your clients. Don't hide behind a rock, which I never do. Admit when you're wrong, which I've been on the U.S. stock market, although I never told anybody to go invest in baked beans and sawed-off shotguns and barbed wire. There were other regions that I liked. I liked regions with a positive equity risk premium, and we liked gold. There were things that actually made you money. Didn't like the U.S. stock market, and look what it did. Phenomenal year, even with the corrective behavior in the course of the past few days. So I was owning up to getting a call wrong. And what I did, yes, I tipped my hat to the bulls. I didn't, by the way, do any mea culpa. I didn't throw in any towel. I didn't make any change to my asset mix recommendations. I didn't change anything. And in the sequel to Lament of a Bear, I talk about why, despite tipping my hat to the bulls and having a better understanding as to what I missed, why I'm not jumping in. But what I said was that it could well be the case, and I posited that the classic valuation metrics we look at may not be appropriate at a time when we've had a major inflection in the technology curve. That maybe I had underestimated the power. I know what AI. I had a whole AI panel on my webcast exactly a year ago. I know about AI. I didn't ignore AI. I just underestimated the impact it was going to have on animal spirits, because earnings expectations this year earnings are going to come in by the end of this year lower than they were forecast by the analyst community this time last year. I don't know if anybody knows that. Earnings-driven recovery. Well, the consensus a year ago was for 10% earnings growth for this year. We're going to get something closer to 8.5%. But the market was up until a few days ago, up almost 30%.
Sure.
The consensus on the S&P 100 this time last year for now was 4,900, and here we're at 6,000 and change. That's over a 20% gap. So I'm not the only one that got it wrong, but when you publish every day and you're out there and you're provocative and controversial, well, you know what? I'm going to have to own up to that. So what I said was that investors seem to be doing what they did in the internet era
Yeah.
in the mid to late 90s, which is basically lengthen their investment horizons. That maybe 1 year forward, 1 year trailing might not be working. Obviously, 1 year trailing. I mean, what rational person would invest today with a 22 to 23 multiple? Who would do that? You have no equity risk premium. The yield in the stock market is the same as the yield on the 3-month treasury bill. Who would do that? You only do that if you're looking at the earnings profile for the next 5 years. That generative AI is going to be this massive game changer for productivity, the cost structure of corporate America, and profits. In my sequel, what I said was, yes, I said all that. However, we went back 100 years worth of data, David, 100 years worth of data, and found that indeed, the earnings growth embedded in the stock market today is 20% average annual growth in profits for the next 5 years, which isn't impossible. It's happened before, but it's a 1 in 20 event. Okay. And if you believe that the AI boom is going to generate 20% growth in earnings per year for the next 5 years, then I would just say to you, this market is for you. This market is for you if that's what you believe. I don't believe it, so I'm in the Warren Buffett camp. This market is not for me, but it might be for you. You do your own homework and see if you can get 20% per year for the next 5 years earnings growth. So in my sequel, I said, yes, I tip my hat that investors have lengthened their time horizons, but even on a 5-year basis, there is a lot priced in. And then you've got to ask yourself the question, David, which is, what does it mean to have the equity risk premium at zero? What is the market telling you? What is the market telling you? This is what I was doing in my piece. Now, I know you read just one part of it, but that's not the real meat. And a lot of this, by the way, is in the sequel, but I think you have to read The Lament of a Bear and then the sequel. And it's available for the general public. What does it mean to have an ERP at zero? The United States is the only country that has an ERP at zero. And the market's telling you that equities in the United States, this is part of the American exceptionalism, equities are a riskless asset when the ERP is zero. When the ERP is zero, the market's telling you that the collection of companies in the S&P 100 are zero beta stocks. Now, if you believe that equities are in the same risk category as the treasury bill market, if you believe that, then this market's for you, David. This market's for you. And by the way, there's people that believe that.
Well, any changes to your previous outlook during this period of introspection?
No, it was basically, if I was going to jump ship,
Yeah.
you know about it by now. It was an explanation as to why I got it wrong. And that's what you have to do. In my business, if you're going to be honest and transparent, you got to explain to your readership, why was I wrong? And then explain why you're wrong, and then explain what you're going to do about it. And there's only two choices. Either you're going to change your positioning, or you're going to stick with your positioning, and then you have to explain why that's the case. Okay, and that's basically it in a nutshell.
So your top assets then for 2025. Anything that you think will have a lot of momentum? Yeah.
Look, I think that we have a lot, even on a long-term basis, there's a lot priced in the stock market. And look, if we miss the train, we miss the train, but there'll be other opportunities. I think it's going to be a pretty rough year for the major averages. And I do believe the Fed will be cutting rates more than expected. I think bond yields will come back down. I am on a 12-month basis, like near term, I expect Treasury yields to continue to go up. I think that we are in the overshoot right now. Um, but our bond duration model for 2025, notwithstanding the near-term clouds, is very bullish. So I like treasuries. I think that the dollar DXY 108, I think that will be coming down. I think the BOJ will be pushed into raising rates during the winter. I think the Fed will come back into rate cutting mode. I think everything that we just saw in the past day we'll be talking about something else come March. So I like the weaker dollar, which means that I like gold. I like the bond bullion barbell, and we are long-term bulls on Japan for a variety of secular reasons. Japan is a remains the legacy of Abenomics continues to be a very positive tailwind for Japanese equities. Um, and there's parts of emerging Asia I like. I think a lot of people turn bullish on China. China's got just too much geopolitical risk in the sense that
Hmm.
they're the piñata for a global trade war. I want to be in Hong Kong, and we put
Yeah.
actually a buy recommendation on Hong Kong earlier this year when the P multiple got down to 8. You have an 8 forward multiple in the Hang Seng and a 22 multiple in the S&P. The
Yeah.
8 multiple in the Hang Seng is the low that we had in the summer of 1982. That was a launching pad for a 20-year uninterrupted, practically uninterrupted bull market. So, there's parts of emerging Asia, including Hong Kong, that we like very much. And outside of that, you have to just pick your sectors. Defense, aerospace, military spending is going up everywhere. That's got visibility. But I think that we're going to go into a year. The consensus now swung towards higher rates. I'm still firmly in the lower rate camp. And so as yield becomes more scarce, you want to find ways to derive yield in your portfolio. So whether in the stock market, utilities, pipelines, uh, I would say telecom services, which had a
Hmm.
banner year. And I think that the financials, I think the banks, which of course, as much of a no-brainer that there is, that they'll benefit from the M&A boom that we're going to see and the deregulation is going to be a huge tailwind. So I think that there's sectors that I do like in the S&P, but overall, I'd be very conservative. Uh, and more important than what your view is on the market is make sure that your composition within the S&P 500 is low beta and low cyclical in the sense that I don't want to have a lot of economic sensitivity because I think the economy is going to underperform expectations.
Yes. Final question. I'll let you go. We have to talk about Canada. What is going to happen with the Canadian economy, the CAD? Christopher Freeland just resigned this week, right? For Americans out there, finance minister. 25% tariffs is the threat from Trump. What's Canada's play?
Well, I don't. Canada's play is not going to be too good for U.S. industry, and Donald Trump's a tough guy, but the Premier of Ontario is also a tough guy, and
Yeah, he
Doug
wants to
Ford is.
cut the energy
Well,
exports.
yeah, well, the energy, exactly, electricity, and then you're going to have oil and gas and critical, minerals. It's not going to be a hit to U.S. consumers, but U.S. industry is going to pay a very big price. That's what I mean. Canada is a small country, okay, but Canada is not unimportant for vital resources that American industry needs. I think the 25% um, was quite a bit of bluster, but I think that, what did he tie it to? He tied it really towards border security. I don't think there's a massive border problem between Canada and the United States, but Donald Trump thinks so, and what he thinks matters more than what I think. But the federal government in Canada just announced a $1.3 billion expenditure to firm up border control, so they're already,
Hmm.
acquiescing. I don't think we're going to see the 25% tariff. Okay, and I'm not bullish on the Canadian economy. I've been bearish. The Canadian economy, I mean, real GDP per capita down
Yeah.
7 quarters in a row.
Yeah.
Um, you're going to have a bit of a hiccup because of this sales tax holiday, but it's really just buys growth from the future. I think it's going to be a rough year for Canada and the economy. But what makes Canada different than the US is that expectations for Canada are so low. Expectations for the US are so high. Canada might actually just might be an upside surprise just by not you know, by not continuing to slip slide away in terms of this descent in real GDP per capita. I had been bearish on the Canadian dollar. I said we were going to blow through 140 when we were close to 130. People were laughing at me. And now everybody's talking about 150, 160, which, by the way, David, will happen if we get the 25% tariff. But because, look, I work in a business where your assumptions drive your conclusions. I don't think that tariff is going to live to see the light of day. I don't think that's going to happen. I think that we could have an election in Canada as early as next month or no later than October of next year. But what Canada faces, considering the Conservatives are up 20 points in the polls, and assuming that doesn't change, and there's no reason why it should change, we're going to have a much more pro-business, pro-market friendly government in Ottawa for the first time since the Stephen Harper years. So I'm taking a look at how the market positioning, goodness
Yeah.
grief, the net speculative short positions on the mercantile exchange are at nosebleed, practically record high levels. So the Canadian dollar actually, and I've been very bearish, and I wrote, oh, by the way, maybe you want to call this a mea culpa too. I wrote a piece today, or sorry, it was yesterday, entertaining the notion that, the Canadian dollar might be a coiled spring next year. Because if those shorts are forced to cover, whoo, daddy, the Canadian dollar is going to pop back, maybe even to 130 again. Was there not too long ago.
Mm.
So I'm not going overboard on that call, but I do pay attention to crowded trades and herd mentality and extreme sentiment levels. We know what that looks like in the stock market, but on the other extreme, that's what it looks like in the Canadian dollar right now. So I'm musing, I'm preparing my readers for pulling the plug at any time on that bearish Canadian dollar call.
Very good. We'll follow up more on that in the new year for sure. David, great stuff. Where can we learn from you? You mentioned you have some newsletters that are available to the public.
No, well, I don't have. Well,
The
anybody.
piece, yeah, the pieces
Well,
that you mentioned. Yeah.
look, anybody can come on our website and get a free 1 month trial of everything that we do. But I referred specifically to two reports I did last week. One was called "Lament of a Bear," and the other one was called the sequel
Yeah.
to "Lament of a Bear." So part one and part two.
Great. We'll put the links down below. So make sure to check that out. Thank you very much, David. Happy New Year. Happy holidays. We'll speak in 2020,
All the best.
2025.
All the best, everybody, in the Chinese year of the snake. And I think of the snake as winding around, and I think that that's the one thing that I should have mentioned, David, which is volatility. I think of the snake. I think of Trump, and I think that you can trade volatility, and if you're good at that, you'll have a
So
very
that's the theme
very
of
fun
2020.
year.
That's the
Huh?
theme of 2025 for you. Volatility, year of the snake. All right.
That'll be my
Thank-
next report.
Yeah, I just gave you a title. You're
There
welcome.
you go. I owe you one.
Good to have you as always, David. We owe you one as always. Thank you for supporting the show. Thank you for being here. We'll speak again next year. And thank you for watching.